if you're an individual investor and you're trying to build your own rental portfolio, it really comes down to a matter of risk tolerance and your capability. And you have to be honest with yourself, your capability to read the tax code and understand the tax code.
Welcome back to another episode of Keeping It Real Estate. I'm your co-host, Dan Breezy, and today we have Brandon Hall joining us on the show. Brandon is a certified public accountant, national speaker, and is the founder and managing partner of Hall CPA. With that said, Brandon, welcome to the show.
Thanks, Dan, for having me on. I'm excited to be here.
Yeah, excited to have you on as well. So, as I'm reading this here, you got the certified public accountant title. Maybe you can help us as, folks that are not in the CPA world deep understand, what does that mean exactly?
Yeah, so the CPA is a license that in the accounting profession is kind of like the high end or the top end of the spectrum of certifications that you can achieve, and it doesn't help you really with tax. So everybody listening to this probably is not as applicable. But what the CPA license enables you to do is essentially sign off on audit reports of financial companies or financials of companies. So that's essentially what it is. It's a regulated field. It's a regulated license, kind of like the bar license. The law license is regulated by state agencies. The same thing with CPAs. We have state agencies that regulate our ability to practice, and that license just gives us the ability to produce audit reports, sign off on audit reports. In the tax world, it doesn't like grant us any special powers necessarily over any other accountant aside from maybe representing you in front of the IRS, which EAs, enrolled agents, can also do. You will see people say EAs are like tax specific and that's better than CPAs, which I don't think is really true. It's just a license that's better than nothing. But it doesn't, like, the CPA license does not make somebody like significantly better or something in tax
Got it.
specifically.
Got it.
So that's kind of, I think, where people get confused.
Cool. So for our listeners, a lot of them are real estate investors, putting money in deals or doing their own deals. What would you say is the most important thing for them to be aware of or be thinking about here coming into mid 2025 and into 2026 as far as tax law goes for real estate investing?
A big one is just following the bills that are going to be going through Congress. So we recently had the outline of the budget passed, and it was large enough to essentially extend the Tax Cuts and Jobs Act. And that's been the Republicans' big ticket item, is extending the Tax Cuts and Jobs Act from 2020 or from 2017 when it originally came into play. And the TCJA, the Tax Cuts and Jobs Act, includes things like 100% bonus depreciation, includes the 20% pass-through deduction, the SALT limit caps, the increased estate deduction, the increased child tax credits. So it was pretty pro-business, very business-friendly, very real estate investor-friendly. So those are some of those provisions that that our clients are all really keeping an eye on, and obviously we're tracking and updating everybody on as well. But 100% bonus depreciation is the big one. I think it's going to be retroactive to January 2025, assuming that they get this thing passed by mid to end Q4.
Wow. So retroactive of January 2025. So basically, your confidence is that it's happening. What's your level of confidence this actually comes back? Because we're buying a lot of triple net right now. We're looking at multifamily deals, and we got brokers telling us if, when, and they're talking about when it comes back. What's the realistic chance of it actually happening? Because I feel like it's unrealistic, but I hope I'm wrong.
Yeah. Don't make investment decisions based on my opinion. And this is exactly what this is my opinion. Insert any other liability removing clause. I would say 95% confidence. And the reason that I am that confident is bonus depreciation and immediate expensing of R&D costs was reproposed last year. And it had both provisions had bipartisan support. So both Dems and Republicans wanted to get that deal passed. But then the Republicans basically started dragging their feet, saying, you know what, we'll just wait and we'll pass it as one package, assuming that, of course, we win the election, which they did. So I think you're going to see it. The reason that it has bipartisan support, so not everything in the TCJA has bipartisan support, and the reason that I'm not 100% is because, the way that these people wheel and deal in politics is you might have to kill something that makes total sense to get something else, right? So if we're sitting here saying, hey, no tax on tips, no tax on overtime, no tax on anybody making less than 150K, you got to pay for that somehow. And so bonus depreciation might might get killed in the process, be an innocent victim in the process of this deal making. But bonus depreciation has bipartisan support in general because it's very pro growth. And what I mean by that is there's a lot of these tax cuts that are being proposed that are just actual cuts. They just add to the deficit. There's nothing, you don't get anything on the back end. But with bonus depreciation, you get two things. When you get the 100% bonus depreciation, the investor makes an investment and they get a tax deduction. So they are putting capital into the system, which is going to turbocharge our GDP. So when you have something like 100% bonus depreciation, your GDP increases as a result of that because people are making capital investments. So that's how you pay for bonus depreciation. But the cool thing about depreciation, at least in terms of the government and revenue, collecting tax revenue, is that when you sell the asset at some later point, you have depreciation recapture. So you don't lose anything with 100% bonus depreciation. It's a way to turbocharge our GDP. And then you get to claw it all back at some later point anyway, because investors inevitably will sell their assets or retire their assets and have to pay that recapture tax. So that's why I think you're going to see it come back. But again, it could get axed accidentally or through the process of deal making.
Yeah. Well, good. I appreciate that. And, I hope your 95% confident level is 100% right. Yeah, that's exciting to hear. So, as an investor, well, I'm hearing you talk right now, and the bonus depreciation recapture is painful. We've experienced it on some of our deals we've exited. How do you see, the most sophisticated real estate investors continue to roll the funds over when they're in private syndications and not get hammered with that recapture?
Yeah, so there's two things that can be at play here. The first thing is if you get allocated a tax loss, if you invest in a syndication or a real estate fund, or even just your own real estate, if you get allocated the tax loss, if you can't claim that tax loss because you don't have any other passive income, then that tax loss will be suspended on your tax returns. And when you eventually sell your syndication, your deal, your fund, whatever, and you pass those gains back to your investors will still have those suspended losses sitting on their books and they'll tap into those gains. So they'll offset each other. So you're actually not really losing anything. Where the disconnect comes is when investors go, oh my gosh, I owe so much in taxes because of all that depreciation that I took at the beginning. What's going on is when you allocated me the 100K of losses thanks to depreciation, it turns out I could use the 100K of losses because I had 100K of passive income or something else like that going on. So what the disconnect is, forgetting that I was able to mitigate gain or income from passive activities thanks to the loss that I received from you. Does that make sense?
Yeah, let me see if I got that right. So the disconnect is forgetting that you were able to mitigate the tax bill then.
Yeah, like 5 years ago, I benefited from it, right? And so if I
Yeah.
benefit from it and it's not being suspended, then yeah, when you go to sell your property and you pass that gain to me, I'm not gonna have any losses to offset. But where we see the disconnect with LPs is the fact that I got to benefit from it a long time ago. The
Yeah.
longer that timeline is, typically the more forgetful we become. Um, but that's the number one disconnect. But the second thing to do is just do something that I like to call, I like to call the lazy man 1031 exchange. So where a syndicate could do a 1031 exchange themselves, but they never do because none of the LPs would be down for that. If you wanted to continue investing in real estate, you can do what we call the lazy man 1031, which is a 1031 without doing a 1031. So I get the gain back from my syndication, and then I take that gain and I go and invest it into a new syndication. And when I do that, the new syndication is going to do the cost seg. They're going to get the bonus depreciation. They're going to pass a loss back to me. I can use that loss to offset the gain on sale from the syndication that exited, as long as it's all in the same calendar year. And that's
Help me
effectively a
understand.
1031 exchange without doing a 1031.
Yeah, so help me understand. I put 100 grand into a deal. There's 100 investors. 5 years later, they sell. They give me 200 grand back. My initial 100 plus 100 in gain. You're saying I can do a 1031 with that and come into another syndication, and it's not a tick?
Yeah, yeah. Well, without actually doing a 1031. So that's the key. So we call it a lazy man 1031 because it gets you the same result as a 1031 without doing the 1031. So if you passed a 200K gain back to me and you
Hmm.
pass that cash back to me, then I could take that cash, and as long as it's in the same calendar year, I can go and invest in a new deal. And I don't even have to invest in another syndication. I can invest in my own property if I want to. But the
Yeah,
key is that I'm getting a new deal where we're going to
yeah,
do the cost egg, the depreciation, because that's going
yeah,
to kick a loss that I can use to
yeah.
offset the gain on sale.
I understand. Yeah, as long as that 100% bonus is there to continue to roll it.
Definitely has become harder to do as
Yeah,
bonus appreciation
yeah.
has been phasing out. Yes.
Yeah, the lazy man 1031 has been popular for years. And as
Yes.
like you've said, as it's phasing out, it's gotten harder to do something like that.
Yes, indeed. Yes, indeed.
Yeah. Yeah, great. So, looking at the real estate market, what motivated you, to get into the position you're at? Because you're pretty young. I mean, how old are you?
34.
34. That's young. What got you excited about becoming a CPA and owning your own CPA firm?
That's a good question. So I started my career at PwC, and then went to EY shortly thereafter. I spent about 3 years total in Big Four accounting, and during that time, did not enjoy it, and through really no fault of PwC or EY, just my own personality. And I spent a lot of time trying to figure out how do you get out of the corporate world, how do you create cash flow and not have to work essentially. And I stumbled across real estate, stumbled across Bigger Pockets. I joined Bigger Pockets and was asking a lot of investor questions because I was trying to buy my own properties. I ended up buying a property, a 3 unit property, and was running some math and realized, man, this is going to take me like 30 years to replace my income. So I don't know if this is going to work. But about that time too, I'd noticed on Bigger Pockets that a lot of real estate investors were asking tax questions. So I just started answering the tax questions. Found a lot of enjoyment out of that, and it's just sort of snowballed into people asking if I would take on clients, which then kind of like gave me that light bulb moment idea of, oh, I could run a CPA firm for real estate investors, and I could through this process learn how to become a better investor myself.
Yeah.
So I started saying yes to people, and that snowballed to where we are today. We've got about 1,200 clients today. I've got a team of over 100 people. We're fully remote. We're in every single state, and all we do is real estate. Real estate investors. We handle all their businesses as well. It's funny. Like I was asked a couple months ago, I was doing a CPA presentation, and one of the CPAs asked me. They were like, "Well, you say you're niched in real estate. Does that mean that you only do the real estate portion of the tax returns?" And I was like, yeah, it's a really good point. I guess we're not as niched in real estate as I thought we were. So
Yeah.
we do a ton of different businesses. We've seen a lot of stuff, but the one commonality with all of our clients is that they are investing in real estate, and it's
Yeah.
been fun. It's been a lot of fun.
That's great. I think about our CPA firm as the kind of the quarterback of the company, and they're there in the beginning, helping us set up the structure of the company. So, for those that are just starting out in real estate, what advice would you give them regarding setting up a solid financial foundation and leveraging professional experts in CPA services like yourself? What would be some of the points you'd suggest they do or think about?
Yeah, it's a good question. I think that if you're an individual investor and you're trying to build your own rental portfolio, it really comes down to a matter of risk tolerance and your capability. And you have to be honest with yourself, your capability to read the tax code and understand the tax code. So, not your capability to go and prepare like a TurboTax return, but your capability to understand what's going into the TurboTax return and why the output is the way that it is, and whether or not that is right or wrong. Because when you DIY your returns, the software is not telling you if it's right or wrong. It's just giving you the output based on your inputs, and you have to figure that out. And some people are good at that. Some people are fine at that. Other people are not good at that, and they need a professional a lot sooner in their journey than others do. So we bring on clients that have 10 properties and they've been DIYing with zero mistakes. And for them, it's just a timing. It's a time issue. They want to buy back some of their time, So they want some tax consulting to make sure that they're in line with what they should be doing on a day-to-day, week-to-week, month-to-month basis. And then they want the end of year tax prep done and probably even some accounting done as well. And we do all of that for them. They buy back their time. They spend more time with their family. We have other clients that they start thinking about real estate and they hire us to help them with consulting. And then once they acquire their very first rental, they hire us to do all the compliance and the accounting sometimes as well, because they understand that competency piece of just like, yeah, I could probably figure this out if I really spent a crap load of time, but it's going to take too much time. So it just depends on your risk tolerance. On the GP side though, kind of like you, right? If I was standing up a new syndication or a new fund, it would be absolutely silly not to include an attorney. I think we would all agree with that, but also not to include some tax counsel as well. We have a specific team built out at our firm that only works with syndicates and funds or GPs of syndicates and funds. And that's what they get called in all the time. I'm structuring a new syndication, I'm structuring a new fund, I'm building this operating agreement before I send this out to investors. Wanted to get your eyes on it. We look at all the tax allocations, make sure that the economics of the deal made it into the tax allocations. A lot of times people will come to us with an idea of what they think is in the operating agreement, and then you read the operating agreement, it's not true. And so we help coach and consult on that stuff as well, because you don't want to get to tax season. And this is why it's really important to use a CPA or a tax attorney as part of this build out process. So you need an attorney for the actual operating agreement, but they're typically going to use relatively standard tax allocation language. So you also need to pull in a CPA or a tax attorney that specializes in partnership taxation, because if you don't, when you get to 315 and we're preparing your return and we're preparing it based on the language in the operating agreement, and you get all those K1s back and you start scratching your head like, this is not what I thought I said, and we have to go and point to the operating agreement and show you these are the allocations that you wrote and you agreed to and you signed off on. Now we have a problem, because you either have to accept the new economics of the deal, which you didn't plan for, or you have to go back to all your investors and try to get an amended operating agreement signed as fast as humanly possible, which obviously doesn't look very good. So my
Yeah.
suggestion is, if you're going that fund route, if you're raising capital, you get a CPA on your team ASAP, you get an attorney on your team ASAP, you lock them in.
Yeah, man, I couldn't agree with those comments more here that Brandon's making. You guys, whenever we're putting together a new deal, it's really efficient for us to get our legal team and our CPA on the same call, even our lender potentially, as we put together the operating agreement, and just make dang certain that everything aligns so there's no surprises, because we get the call every time around this time of the year. Hey, taking a look at the operating agreement, just making sure that you guys have dialed this in that way, etc., and just making sure it is what you told your investors. So absolutely critical before you close the deal to get that dialed in, and before you even really start raising money, before you bring it out to your investors. So critical to have them in early. What would you say some of the biggest mistakes you see investors making right now?
Um,
Would it be just not having people on their team early enough, or is it something else?
Yeah, I think the biggest mistake that I'll say newer investors make, or even LPs make, people that are not really like fully running a real estate business, I should say. So newer could also be like, I've got a handful of properties. The biggest mistake that I see investors make is getting FOMO. And what I mean is, as investors, we are more entrepreneurial than most Americans, right? Most people, we're taking more risk than most people are willing to take simply by buying a rental property. And because that puts you into a different category, you tend to try to find people like you. So what happens is you start forming these little communities, and in those communities, people will tell you, "Hey, my CPA lets me qualify as a real estate pro." And then you start getting this FOMO and you go, man, I want to qualify as a real estate pro. And you start taking positions that you don't actually qualify for, based on your social network, essentially, based on what other people are doing in your social network. So I would just really encourage people to get your CPA to tell you whatever. But if you feel like it's a little off, get a second opinion. I promise you, you do not want to get audited and having taken all this risk knowingly or unknowingly, and have to unwind it and pay back taxes and penalties. That's probably the number one mistake that I see, is just people wanting tax deductions way too much. It like really trying to optimize for right this second rather than thinking about the risk of the positions that they're taking that they probably can't substantiate, and also the longer term strategy. Like we can do all sorts of fun things right this second, but does that actually make sense in your 10-year wealth building plan? And a lot of times it
Yeah.
doesn't. A lot of times it's just buy a rental and stop.
Yeah.
That's all you got
Yeah.
to do.
Yeah. Well, let's talk a little bit about what qualifies legit as a real estate professional. Like, from your perspective, what is it that this is how it has to be? Otherwise, you don't qualify. Can you make it simple or is it gray?
I mean, there are some simplicities. It's also very nuanced and gray. So, from a very simplistic viewpoint, you have to spend 750 hours working in a real property trader business, and you have to spend more time in real property trader businesses than you do anywhere else. So, if you have a full time job, if you're running a business full time like me, I can't qualify as a real estate pro because I can't spend more time in real estate than I do at my CPA firm during the year. It's just, even if I could, the IRS is never going to buy it, which means I'm going to go to tax court. So I'm going to spend $30,000 going to tax court, and then the tax court judge is also not going to buy it. So that was a complete waste of time and money. So if you work in a full-time job, you cannot qualify. If you're married and your spouse is not working a full-time job, your spouse could potentially qualify, and then you would have a married filing joint real estate professional status tax return. So that's a way to get around it, but you got to convince your spouse that real estate's awesome, and sometimes that's hard for people. It's one of the early pieces of the consulting that we do with high income earners is the high income earner hates paying taxes, wants to hire us, spouse joins. High income earner says, "Oh, my spouse will be real estate pro," and spouse is like sitting there on the Zoom camera, like, "What?" So you got to make sure your spouse is actually on board. But that's the simplistic version of it. Now, where it gets nuanced and complicated is what exactly is a real property trader business? What time actually counts and doesn't count? So a lot of people will think, "Hey, if I listen to this podcast that we're recording right now, that's real estate professional status time," which is not true. There are some relatively well-known CPAs that will tell you, "Hey, you can go on a real estate cruise, a seminar, and that counts for real estate professional status." And that is not true. People will say, "Hey, there's a difference between real estate professional status hours and material participation hours," and that is not true. So the nuance is just, it can get pretty gnarly, and that's where that expertise really starts lending a hand for your risk reduction, essentially.
So what does qualify? What are some examples, like working on site, managing a property? I mean,
Yeah,
being there, painting a unit, doing the
yeah,
work.
yeah. The way to think about it is time that's swinging the hammer. So if you're sitting there and operating, then you're good. If you have a property manager that's operating for you and you're just kind of checking in, then you might not be good. If you're buying in a different state, you've got a property manager and you're forcing a weekly check-in call, and you've got a day job that's not real estate related, and that's pretty much all you do with the real estate is just talk to the property manager, probably toast. If you're in your position and this is all you're doing all day long and you've got your property management team fully integrated, you're probably fine, right? So it's like those are the nuances. This is what you do full time versus a physician that's buying rental real estate part time. That's where that difference comes into play. The hours that people love to log that do not typically count are going to be education time and research time. So going to those seminars, going to those cruises, listen to this podcast. That time's not going to count because it doesn't actually impact your property on a day-to-day basis. That's like the underlying issue. Travel time typically does not count for real estate professional status, and then investor level time is not going to count for real estate professional status unless you are involved in the day-to-day management of the activity. And investor level time is like bookkeeping time, time paying bills, preparing tax returns, talking to my lenders, due diligence, all that type of stuff is investor level time. Basically, time that any investor would spend to make sure that their investment was sound is investor level time, and investor level time does not count unless you are managing the day-to-day of the rental. So those are the three buckets that don't count: investor, education, research, and travel time. But if every other time, like advertising the property, collecting rents, evicting tenants, managing, doing any of the repairs, the capex, anything like that, all that time is going to count for real estate professional status.
Great. And in real estate professional status, what does it do? What changes? Like, yep, you're a real estate professional. What does that allow for you to do now?
I'm glad you asked that because I just realized we didn't even explain that. Yeah, who cares?
Yeah.
Uh, all right. Yeah, let's explain that. So your rentals, when you invest in rental real estate, you are now subject to the passive activity loss rules. Actually, you're always subject to the passive activity loss rules, but you just don't really find out until you invest in rental real estate. So rental real estate is by default considered a passive activity, and passive losses from passive activities can only offset passive income. So if you invest in a rental, let's say I buy $1 million office building and I do a cost seg and I get a $200,000 tax loss thanks to that cost seg, that tax loss is passive by default. And if I don't have 200K of passive income, then that tax loss just gets suspended on my tax returns and it just hangs out until I either sell the office building at some future point and then I can unlock that loss, or until I generate passive income to offset that loss. Real estate professional status allows you to get around those passive loss rules. So if I qualify as a real estate pro and then I go buy this office building, I can use that 200K loss to offset my CPA firm income, or offset my W-2 income, or my retirement income, or my interest or dividend or capital gain income from selling Tesla stock, or I guess capital loss depending on when you sell Tesla stock these days. But that's the benefit, is that it enables me to actually use my rental loss in full when I qualify as a real estate pro. And the way that it can help LP investors too, because you might have your LPs listening to this podcast, is, when I invest in, if I were to invest in your deal, the losses that you pass back to me are passive. Even if I qualify as a real estate pro, I cannot make your losses that you pass to me, I cannot make them active. So I can't use them to offset my CPA firm or my W-2 income. The reason for that is, even if I qualify as a real estate pro, I still have to show that I materially participated in the activity that's giving me the losses. So I can't materially participate as an LP because I'm an LP. I'm just an investor. I'm a silent partner. There's no way that I can materially participate. Even if you let me, the code says I can't materially participate, so it doesn't matter. So if I'm an LP, that's passive no matter what, even if I qualify as a real estate pro. But where it gets interesting is if I went and built out my own rental portfolio and I self-managed my own rental portfolio. So I qualify as a real estate pro and I also hit the material participation tests on my own rental portfolio. I can make a grouping election. It's under regs 1.469-9G. I can make a grouping election that groups in my rental portfolio with all of my LP investments as well. And it treats everything as one activity for the purposes of these tests, which just means that I can make everything active income or loss, or non-passive income or loss, by making this grouping election. So if I invest in your deal without building out my own portfolio, the losses you pass back to me, they're passive, nothing I can do about it. If I build my own portfolio out, I qualify as a real estate pro, I materially participate in my own portfolio, I can go and invest in your deal and a million other deals, and I can get these losses passed back to me. I make a grouping election to group those LP investments in with my own portfolio, and now everything is non-passive. It's a really great way for our higher income earners to control their taxable income on a year-to-year basis, because they can make a 100K investment into a syndication, and that syndication passes a 70, 80K loss back, and that directly offsets their income because their spouse might be qualifying as a real estate pro on their own portfolio.
And what section of the tax code is that again?
That grouping election was 1.469-9G, Treasury Reg. Yeah.
-9G. This is interesting to know that it's the 1.469-9G of the tax code. That's why you got to hire a CPA, ladies and gentlemen, unless you want to sit there and read.
Yeah, and I mean, circling back to what are some mistakes that new investors make. But I mean, we've helped with a lot of real estate professional status audits, and probably the number one mistake that we see is not making that grouping election. And when you don't make that grouping election, what you have to do is you have to prove that you materially participated in each rental separately. So if you've got 10 rentals, you have to spend like 100 hours in each rental separately, and you have to spend more time than everybody else. And that's one of the 7 material participation tests. But the point is, it's really freaking hard to do. So you got to make the grouping election is the moral of the story, but a lot of people forget about it, and a lot of accountants don't do it just because they forget about it. But if you get audited, the IRS auditor will typically ask, did you make this grouping election? And if you can't prove that you did, that's a big gotcha for the IRS, because then they look at you and they go, well, cool, prove that you materially participated in each one of these rentals separately, and you're typically not gonna be able to do that.
Wow. Complexity. You got to have somebody that knows the tax law inside and out. That's for dang sure. What are some of the most common challenges you see real estate investors facing when it comes to tax planning and financial management? Anything that comes to mind and beyond the text, missing the 1.469-9-G?
I mean, yeah, we could talk about a lot of misses, but the biggest challenge is just investors just don't know what they don't know, right? I mean, it would be like me trying to give myself or trying to really understand legal advice or medical advice. It's like I don't really even know what questions to ask to make sure that I'm getting all the information to make a good decision. That is what we see a lot of, especially when we are onboarding new clients who have been working with like a local accountant that they've had forever. We really try to start with the education and really helping them understand the entire scope of what they're doing so that they can then ask the right questions.
Yeah.
So that's probably the biggest issue. But big mistake that I see, this is probably something that shows up on 95% of tax returns, almost all the tax returns, is not using partial asset dispositions. So the 2013 tangible property regulations that's the de minimis safe harbor that you see every once in a while, like the $2,500. If you have an expense below $2,500, you can just expense it. That's where this comes from, is the 2013 tangible property regs. But also in those regs is something called the partial asset disposition. And what it allows you to do is whenever you are making an improvement to your property, you can deduct the cost, the remaining cost of the component of the property that you are ripping out of the property. For example, let's say I buy that $1 million office building and it comes with a roof, hopefully. If I then go and later add a new roof or replace the roof, most accountants, where the mistake occurs, most accountants and most DIY filers will simply take the new roof of this, again, $1 million office building, so $40,000 roof. They'll take that new roof and they'll depreciate it by 39 years. So you'll see it show up in the tax return as an extra 40K divided by 39 years, and that's the depreciation you're claiming. The problem is that if you don't deduct the cost of the roof that no longer exists, the old roof, right, then you are now depreciating effectively two roofs. You're depreciating the roof that you just put on, but you didn't deduct the cost of the roof that no longer exists. So it's still technically in your tax returns, even though it's not physically on the building. And you see this show up time and time again with HVAC, with water heaters, with plumbing, with electrical, with roofs, with windows, with doors. People add the new cost to the tax returns and they start depreciating that new cost, but they don't write off the cost of the component that is no longer physically there. And so that is what we see as a ginormous missed opportunity, because it requires nothing from you, Dan. Like, you're the client, right? It requires nothing from you. All you have to do is give me an invoice. That's all you have to do. I can figure
Yeah.
out what the component is that was ripped out, even without a cost segregation study. I can figure out that value. So
Yeah.
it's super passive for the client because the client doesn't have to think about it, but they're getting tax strategy integrated into their asset
Yeah.
on an ongoing basis.
You know, it's so complex.
It
It's
is.
there's so much to it. And I'm just curious, what are your thoughts on, as we continue to see AI roll out, how does that affect the accounting industry? Like, what comes over the next 10 years as AI becomes more and more sophisticated?
It's a really good question. I will give you the accounting industry hopeful answer and then the realistic answer. The hopeful answer is, and maybe this is the realistic answer, everybody thought that computers were going to replace accountants, because before computers, we were all doing it by hand. But when computers came out, what it enabled accountants to do was to just do more of the same work. And so I think that the industry right now believes that AI will enable us to do more of the work and focus more on the advisory and that education component. So rather than, like, imagine a world where your accountant says, "Hey, Dan, can you upload X, Y, and Z?" You upload X, Y, and Z, and tomorrow your tax return's done. That would be really freaking cool, right? And I think that AI can eventually enable that, a 1 day turnaround time of a tax return. And what that would enable us to do as accountants is actually have a call with you during the peak of busy season and walk through your return so that you fully understand it, so that you can then translate that to your investors. Or heck, we probably even have time to sit on all of the calls with all of your investors. You don't have to worry about that, right? So it's going to enable us to do a lot more of the kind of like the client service communication piece that a lot of firms are not able to do right now. I think that's like short to midterm. Long term, Long term, it's going to be interesting. I don't see a situation in my career lifetime, my next 20 years, where non-tax people could effectively use AI to get the right answers. Like a lot of people that you see on social media right now that are using ChatGPT and things like that to try to get tax answers, they celebrate it. They're like, "Oh, this is amazing." But then you got all the tax people that are like, "But that's all wrong." And I think that's going to get better over time. But I think at the end of the day, it's always going to be a function of garbage in, garbage out. So if you don't know how to prompt, then you're not going to receive the right answer. And I think that's just going to take a long time for people to figure out. But I think the more interesting thing for accountants is going to be eventually AI is going to be so good that a lot of that compliance work, a lot of the dirty work that we do behind the scenes is going to be done by AI and by the softwares that are developed from it, enabling us, like I said, to spend more time on the client relationships. But the problem is that we're only ever going to be able to take on so many client relationships, right? Like if my cap's 100 relationships that I can remember everybody's names and your daughter's birthday and your wedding anniversary, adding AI to the fold might take me from 100 to 150, but will it take me to 500 relationships? I mean, that's a ton. That's just a lot to manage, right? I
Mhm.
think that's where the issue is going to eventually crop up and that's the real threat, I think, to accounting.
Got it. Well, I
Yeah.
appreciate that. So, gosh, good stuff here. Before we start to part ways, I'd love to give our listeners a book recommendation. Anything you have that would be positive for our listeners to consider reading? Any recommendations?
Yeah, I've got a lot back there. My recommendation that I give to everybody is read How to Win Friends and Influence People by Dale Carnegie. It's a phenomenal book. I read it probably once every year, once every 2 years, and it's just a really good reminder of how to empathize with people, how to put yourself in other people's shoes, how to communicate more effectively. Great book. Definitely helped me build my business.
Yeah, I would second that. That book is a life-changing positive book, especially as you get into business or are building a business to create relationships. People do business with people they like, and if you can be a likable person, you can move the needle drastically. So, thank you so much, Brandon, for joining us on the show today. If our listeners wanted to get a hold of you, how can they reach out to you?
Yeah, the best way is check out our website, which is at www.therealestatecpa.com. You can look at all of our content. You can fill out a web form if you're interested in consultation. But there is a resource on that website that I do want to point everybody to. If you go to therealestatecpa.com and hover over resources, there's a 2025 tax legislation tracker. So we are keeping daily tabs on what's happening in Congress and what various politicians are saying they want to include in the tax bill, and we're tracking all of that for you so that you can get one source, one non-political, bipartisan, whatever, however you say it, one source that all we care about is the actual taxes, what's happening there. So that's been
Yeah.
pretty popular. But other than that, that's it.
Awesome. Well, thank you so much for tuning in to another episode of Keeping It Real Estate. If you haven't already, make sure to visit our website and fill out the contact us form to just ensure we can keep you up to date with important real estate news as well as future investment opportunities. And thank you so much for listening. We'll see you on the next episode of Keeping It Real Estate.